over the last week, the S&P 500 has been very mixed right across the board, and today is the big day. What will Jerome Powell and the Fed decide on the interest rate? Are we going to see the 25 basis point or are we going to see the 50 basis point? And actually it is fairly mixed 50-50 in terms of what traders are anticipating. But right now, as of market open on Wednesday, we can in fact see stocks have moved very minimally and everyone now is on tenterhooks. Now, our main focus of today's episode, we're looking at 4 undervalued dividend stocks. Each one of these has a yield of around 5% or more, and we're going to get straight through it, whether or not we believe these are big time buys. And the first one, none other than UPS. This one over the last 12 months, down around 18%. Over the last 10 years, you would be up only around 35%. Granted, it doesn't include dividends reinvested. You would have severely underperformed the S&P, and we can see all-time highs, January 2022, $225. We can see right now it is trading around half of that all-time high. As we mentioned, yield around 4.99%, forward P 17.5. For those that want to know, S&P right now before the interest rate talks is sitting around 23. And we get one buy rating from Wall Street, a hold from Seeking Alpha, and a hold from Quant. In terms of how they've performed, well, their latest earnings, they actually reported quite a large miss of around 20 cents. We do note the previous 3 they did in fact beat, so a 75% track record. With the next 4 quarters, they are anticipating growth earnings per share year on year. Nice to see quarter 1 and quarter 2 of FY25 double-digit growth, and the EPS estimate will bring that forward P down to around 14.6. Now, in terms of this company, the dividend safety score does sit at 69, so it does look to be safe, and we're going to run through all of these metrics to understand as a whole, is this a high quality company that can give us a very nice yield? Now, it was just reaffirmed in July this year of the safe score, and this ultimately means that a dividend cut is unlikely for United Parcel Services. Now, for those that are interested, some key metrics from the last recession, Great Recession 07-09, they actually maintained the dividend, didn't increase it, but also didn't cut it. They had average growth, negative 12%, which was pretty much spot on of the S&P, and they only marginally outperformed, negative 48, as we can see here, the S&P itself negative 55. Now, when we take a look at dividend growth, very disappointing, only 0.6% increase this year. As always, we want to see at least 4% or more just to be in line with inflation. Nice to note, over the last 5 and 20 years, this has been at the double-digit rate, which is one of the reasons why we were disappointed from that very trivial increase. We also note 14 years of consecutively increasing the dividend, and we can in fact see they have been paying a dividend for the last 55 without a reduction. Now, a new feature that we do have on this channel is where we can take a look at how they've performed over the last 20 years. Now, this relates essentially to their forward P to understand where we expect the price to be. Now, over the last 20 years, we can in fact see it is right at the bottom of the expectation. When we zoom into over the last year, we can in fact see the expected price is around the range that we can clearly see here. In fact, when we have the current price of 131, the expected price based on this model is around 123, 150. But as always, we will get to our own valuation model. And the main thing that we look at in our videos is dividend yield theory. Now, this states a company is undervalued with the current yield 4.97 above the 5-year 3.38. We do also note the forward P of 15.9 isn't too far off the 5-year 16.6. So a double undervaluation signal. In fact, today for UPS, a triple undervaluation score, as the sector whole industrials sits much higher at 19.8. Then we get to the free cash flow payout. As always, below 60% is our target, and this is why we call this a red flag indicator, something that you wouldn't pick up looking at the earnings rate. And remember, we don't typically look at the earnings data due to the fact it is susceptible to manipulation by management through their accounting. So below 60%, 110% indicates to us that management paid out more in dividends than they generated in free cash flows. So do bear that in mind. Nice to note though, over the next 12 months, this is expected to come down. 81%, not near our 60%, so don't expect massive growth over the shorter term with UPS. That would be our expectation. And we do in fact see free cash flow, whilst over the longer term we want to see increases consistently. It has only done one of that. It has increased from 371 to 591, but there is a very, very strong lack of consistency here on the year-on-year basis. The nice thing to report though is over the next 12 months, this is anticipated to increase to around 803. Then we get to the sales growth where we want to see at least 3 to 7%, something they've done very well over the last 10 years. Other than the more recent year of 2023, they had a 9% drop to their top line. And when we do take a look at it from a numerical perspective, it is nice to see that growth over the longer term. Hopefully we can see that continue over the next 12 months and beyond. And we also understand that they have taken over that contract from FedEx for the USPS. Now, in terms of the shares outstanding, we can also see some returning of excess cash to shareholders through those share buybacks, coming down although very inconsistently, and in fact we do notice a period from 2019 to 2021 where they were diluting your position as a shareholder, although very briefly and again very trivially. This isn't something we would expect year on year. There is also a fair lack of consistency from management. In terms of the ROIC, now we love this and we also don't like this. The reason why we like this, it is above the 10% minimum we want to see. However, there isn't that consistency and it has been decreasing over the longer term. Quite a big drop from 22 to 23, 29% to 20%. Over the last 12 months at 17%, does make us worry a little bit that this will start to come down year on year. Definitely something that we would say to keep an eye on, but overall, nonetheless, even 17% on a trailing 12-month basis in isolation, that number is very strong. Remember, it does give us faith management are able to effectively allocate their capital. Now, in terms of the operating margin, we want to see operating efficiencies with this number increasing over the longer term, pretty much straddling on a year-on-year basis as we can see. In fact, going down to 9% on a trailing 12 months. So again, something just to bear in mind. Ideally, we want to see it increase. We would be okay if it does maintain, but this is something like some other metrics with UPS that has for the large part been fairly inconsistent. Nice to report though, free cash flow around the 5% level that we do want to see as a minimum year on year. Then we get to the net debt to EBITDA, earnings before the interest, tax, depreciation, amortization. It's been below 3 every single year, so that is a very good sign because remember, this ultimately does correlate to balance sheet dividend safety, and we can see these are the number of years it would take the company to pay off all of their debt net of cash on hand. 1.58 in 23, 1.54, so minimal movement over the next 12 months. Does show us that UPS does have a strong balance sheet, and ultimately the dividend for now does look to be safe. Now, getting to the intrinsic value, our price of $149. How we got this? Well, we did run it through these 3 models. Now, on our deeper dives, we go through each one. Today, we're going to get straight through it. And at 149, we always like to add a margin of safety. Now, remember, this company is giving you a 5% yield. And right now, with interest rates coming, we do believe that a lot of money will be coming out of their savings from those on the sidelines into some high yielding companies like UPS and others we will go through today. Now, with a 10% margin of safety, an acceptable buy around $134. Remember, we only really use 10% if we believe it has a wide moat, strong financial metrics, and good forward-looking data. Then we keep going till it's near the current trading price. Now, you could argue at 15% around 126,127, UPS isn't far off that. So in today's episode, around 10 to 15% MOS, with Wall Street indicating $150 price target, upside of 19%. So they do obviously believe this is a buy, as we did already see from the rating summary at the beginning of the episode. As always though, do give us your thoughts in the comments below for each one of these stocks, whether you are buying, whether the yield is even attractive, or maybe this doesn't fit your portfolio and why. Now, before we move to the next stock, just to let you know, we have released our latest free weekly article. If you want access to this or any others, you can grab a copy by clicking on the pinned comment below. And we have also released our 25 undervalued stocks for the month of September for your consideration. So do go ahead and check that out by clicking on the pinned comment below. And there you will also be able to grab 22 stocks which have the most upside according to Wall Street, that again we would highly recommend you check out if you are looking for large gains over the longer term. The next stock we're looking at, one we haven't covered in quite some time, is Devon Energy Corporation. Now we get a double buy with the hold from Quant. This one again trading towards its 52-week lows with another yield very similar to the previous company at the 5% point, and we can see the forward P at 7.8. Now, over the last 12 months, down around 21%. Over the last 10 years as well, we can see down around 42%. But remember, this is if you had bought this company 10 years ago today. For example, if you bought it around 2020 with that COVID drop at $6, you would be up a very significant portion. Now, in terms of how they performed, well, always great to see companies that beat analyst targets. That is a 100% track record, although we do note some mixed numbers moving over the next few quarters in terms of the earnings per share. Ultimately, though, for the next full year, they are anticipating growth. That forward P, as we can see, will come down to 6.83. Dividend safety score does sit at 41, borderline safe, so we can take a look and understand why. Now, again, this was reaffirmed just a few weeks ago, ultimately meaning that there is a moderate risk of a dividend cut over a full economic cycle. And in terms of those that do believe a recession could be near, they maintained the dividend during that period. They had below average growth, but pretty much spot on with the S&P return, negative 54. Now, we can see they have had a dividend cut over the more recent year, but over both the last 5 as well as the last 20 years, they have increased those dividends at a double-digit rate, and that does explain some of the reason why the share price has dropped. So they do therefore have 0 years of consecutive increases, as well as 0 years of paying a dividend without a reduction. Now, in terms of looking at this from the purely new model, which tells us the valuation, what we can see, we have an undervaluation signal, and when we do take a look at where it fits, in fact, over the last 20 years, this company has been trading well below its fair value. When we look more in detail over the last 12 months, we can see it doesn't even reach the bottom of that expected price. And very similar conclusions to be had on dividend yield theory. Yield does sit higher than the 5-year rolling. We also note the forward P does sit lower than the 5-year average. And when we do compare it to the energy sector as a whole, Devon Energy does give us that triple undervaluation signal today. Then when we take a look at the payout ratio, below 40% we want to see for oil producers. Again, remembering that this industry is cyclical, we do note it has been fairly high over the last few years, and in fact the positive to take is over the next 12 months, this is anticipated to reduce down to around 36%. Then we get to the free cash flow per share, not the greatest from 2014 to 2016, but from the 2017 positive position, it has nearly doubled. Again, bear in mind that inconsistency, which we do expect from the industry, and also nice to see growth anticipated over the next 12 months. In terms of sales growth, very similar when we look at Chevron, when we look at ExxonMobil and others. Negative growth is staple within cyclical industries, and in fact we can see here 6 years of negative growth, including the more recent year of 2023. Now, in terms of numericals, well, in fact, 17.2 billion reported in 2014, down to the COVID lows of 4.67 billion, and now we can note a bounce to around 14.4 billion. Now, we also want to make you aware that there has been no return of excess cash, and over the longer term, they have diluted your position as a shareholder. Then when we get to the ROIC, actually looking very strong just over the last 3 years, significantly above that 10% minimum level that we want to see, and also looking very good. Remember, margins above 12%, much better over the last 3 years, and again, the same can be said for that free cash flow margin, especially from 21 to 23, with the trailing 12-month basis, both on the free cash flow and on the operating margin looking very good. Then we get to the net debt to EBITDA, and in fact, when we want to see below 1.5 for this industry, that is exactly what we get over the last 3 years, and we also note over the next 12 months, this is anticipated to go lower. So given this metric of 0.67, as well as the free cash flow payout expected to be fairly low over the next 12 months, for the time being, we do believe that Devon Energy dividend is safe. Now, first thing that you probably will spot when we run it through the valuation model is that Wall Street are very bullish. In fact, a $58 price target does indicate 42% upside. And when we look at our own price valuation of $59, it isn't too dissimilar from Wall Street as well. Now, remember, you can grab a copy of this model by clicking on the pinned comment below, writing your own numbers, whether it's for Devon Energy or any other company. So a 10% MOS would be a buy at around $53, and then we keep going till it's near that current trading price. And what we in fact note in today's episode, you are getting at least a 30% MOS. Whether or not that will be sufficient for a company like Devon Energy is one to consider, and as we can see, 42% upside. As always, do give us your thoughts below. The next one we're moving on to is CVS Health. Now, we have a buy rating from Wall Street with a double hold. This one again trading towards its 52-week lows with a yield of 4.6%, a forward P of 8.8, and over the last year down around 18%. Over the last 10 years, again, down around 28%, and we can see all-time highs sitting around January 22, so about 2.5 years ago, at $108. Again, right now sitting around half that price. In terms of their earnings, they have got a 75% track record. They did miss in quarter one, but the more recent quarter, we can see quite a nice beat of 10 cents, although we do note 2 decreases anticipated over the next 4 quarters, but still an EPS estimate increase in December 2025, with the forward P coming down to around 7.9. Now, very nice to report a safe dividend score of 80, and we can see here an undervaluation signal with very promising increase to their dividend just in the more recent period, 9.9% in December 2023. Now, when we take a look at the last recession for CVS, they increased the dividend, they had above average growth, and they also significantly outperformed the S&P, negative 38%. We also quite like the dividend growth. Whilst over the last 5 years it has kept up in line with inflation, over the last 20 years we can see strong double digit of 16%. We also note 2 years of consecutive increases, although they have been paying a dividend for the last 27 years without a reduction. Now, when we take a look here based on dividend yield theory, again, massive undervaluation with the stock price significantly lower than the expected. And when we do zoom in on that, you can clearly see this company has signaled for quite some time, in fact, that it is trading well below its fair value. Now, in terms of dividend yield theory, we also get that as well. 4.6%, significantly above 2.9%. But remember, we will conclude when we do come to the valuation. In terms of the free cash flow payout, below 40% for this industry, that is what we see every single year, as well as anticipated with the 35% over the next 12 months. And whilst the free cash flow has been inconsistent on a year-on-year basis, we do see growth nonetheless, but we have to point out over the next 12 months, a small drop is anticipated. Then when we take a look at the sales growth, well, double digit is what we actually see nearly every single year, so it does look very strong, especially the last 2 years of 11%. And even on a trailing 12-month basis, 7% does still look fairly respectable. We also note that they have pretty much more than doubled their top line over the last 10 years. However, they have diluted your position as a shareholder from 2014 1.17 to 2023 1.29. We then move on to the ROIC, where we do see it lack for this sector of around 17% or more. Nonetheless, 9 to 11% isn't too bad over the last 2 years. 7% on a trailing 12-month basis does indicate it has started to decrease, just something to keep an eye on. We don't want to see this go much lower. Then in terms of the margins, this industry as a whole is notorious for having very low margins. The one thing we do want to highlight is the decreasing nature. When we look at other examples like Costco, like Walmart, like Target, we will see very similar low margins. One thing that we may not see is this decreasing nature. 3% on a trailing 12-month, again, something to be aware of. We also note free cash flow margin has been lacking over the longer term. We then get the net debt to EBITDA. Now, below 3 is what we want, and that isn't really what we see. In 2023, around that level, and the next 12 months anticipated to go higher. Again, just something to keep an eye on. Dividend does look to be safe for now, but as always, with companies, there are metrics you do need to monitor moving forwards. Then we get to the intrinsic value, and as always, if you are enjoying the content, value is being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. With a margin of safety of 10%, it does look to be a buy at around $66, at 15% around $62, at 20% again pretty much around the current trading price, with Wall Street indicating a $68 price target and 17% upside. Now this one does have a slightly lower yield than the 5% that we have seen from the previous two, but nonetheless you could argue it actually has better growth based on historical data. We then move on to the next one, which is BP, the oil and gas giant, where we have a buy rating from Wall Street and a double hold. This one trades at the lower end of the 52-week range, the highest yield today at 5.5% and a forward P of around 8.1. Now over the last year, again down around 16%. Over the last 10 years, again as you can see, down 27%. And we also note around the COVID year, it was sitting around the $15 mark. So right now, if you had bought since then, you would be up more than double. Now in terms of their earnings, nice to see their more recent one. They did have a beat and pretty much a 75% track record. They did miss, although that was 4 quarters ago. Moving forwards, we can just see the cyclicality in the industry, some years positive, some years negative. although the main thing to take away, forward P anticipated to come down with the increase on the full year EPS estimate in December 2025. We have another borderline safe score sitting at 50 with an undervaluation signal, as well as a very impressive double-digit increase just in July this year. Now, in terms of looking at this in the key metrics for the recession, they actually maintained it. They did have below average growth. As we can see here, they did in fact marginally outperform the S&P. Now, we do note a dividend cut over the last 5 years, and we also note over the last 20 years, it has sat at around 0% year on year. And when we do take a look at it from a numerical perspective, they have increased those dividends for the last 2 years. Lots of considerations to take in. Some investors won't mind that. However, that will put off some other investors. And when we take a look at it over the last 20 years, we can in fact see some years it has traded above the expected price, some years below. And in fact, a more detailed analysis does show us right now it is sitting below what we would deem to be at best the minimum value of this company. Then when we take a look at the valuation data, specifically dividend yield theory, we have that massive undervaluation signal, although we do note the forward P pretty much sits in line with the 5-year average, although it does sit significantly lower than the energy sector of 12.4. Now when we take a look at the free cash flow payout over the last few years, it has looked very good, 38% expected over the next 12 months. And in terms of free cash flow, very similar to other oil and gas companies we look at on this channel, whilst it has increased over the longer term, inconsistency and a decrease anticipated over the next 12 months. No surprises with these negatives that we see, 6 of the last 10 years in fact negative 13% in the more recent year, and ultimately we can see the peaks and troughs just in terms of a numerical perspective. What they have done over the long term is yes, return excess cash, but in fact many years they have diluted your position. Nice to report from 2021 they have started to share buybacks and fairly aggressively as well. Hopefully this is something they will continue into 2025 and beyond. ROIC as well looking good over the last 3 years, something that we can say as well very similar when looking at both operating margin as well as the free cash flow, above 5% as well from 2021. Then when we get to the net debt to EBITDA, below 1.5 is what we see over the last few years. 0.88, so a marginal increase from 2023, but again it still does look fairly positive, especially when you consider the free cash flow payout. Therefore, for now, the dividend does look to be secure. Nice to report our intrinsic value of $44, pretty much in line with Wall Street, where they see the price over the next 12 months. They have upside of 35%, and when we do take a look through the MOS calculation, at 10% a buy at $39, at 15% a buy at $37, and as we said, we keep going in today's episode to pretty much say that BP has around a 25% MOS, with Wall Street giving this a very nice upside of 35%. As always, if you enjoyed today's episode, smash that like button, hit that subscribe and bell. Let us know your thoughts below. Don't forget to sign up to the free weekly newsletter. And as always, come and join us in the Patreon where we do talk about our weekly buys and sells. As always, have a great day and we'll see you all on the next one.